At the end of my last video, I showed you a list of all the financial assets in the world, but with no explanation provided. There simply wasn't enough time, and I just wanted you to know they exist. It is my belief that you must first understand the pieces on the board before playing the game. It's also important to me that people know about these financial assets, because this will allow me to transition into some theories and strategies about global macro investing in future videos, hopefully without losing viewers by not explaining these concepts again. If my previous video achieved its goal, by now you should have a pretty good understanding about the importance of financial assets, and you should also have a list of those assets that you might not know much about yet. In this video I will try to fix that, and I will tackle the topic of capital markets with the goal of uncomplicating it for you. So let's begin. In the simplest of terms, capital markets allow you to take your savings and put them to long-term productive use by either buying ownership in companies or by lending your money to companies or governments in order to receive it back with interest. Basically, capital markets allow you to be an investor or a bank by giving your money to entities who need it to achieve something. In return, these entities will either give you ownership in them or more money back. As a side note, usually when people hear about putting their savings to productive use, the first thing on their mind is to start a business. What most people like to ignore though, is that starting a business is probably one of the riskiest things you can do in life, especially if you don't have much experience to begin with. This is the reason why most of the videos on my channel, until a month ago, were business related. Not because I want to discourage people from doing that, but because I know that people tend to gravitate towards starting a business, and I want them to be aware of the risks and the complexities of such an endeavor before they commit to it. Obviously, for some people this is a no-brainer, and they would argue that a good business can give returns that are hundreds of times higher than any investment, so there's no point in chasing meager returns in the financial markets. Others could argue that the average business only has around a 10% profit margin, which is similar to an index fund. So you're better off just investing your money. It's not like you could be better at business than mega corporations, which are designed to maximize revenue and profits, and who employ thousands of people to achieve this goal every day. It's easier to just give your money to these corporations and these entrepreneurs who are better at doing business than you, while you sit back and reap the rewards. Well, if you were to look at a Forbes billionaire list, what you'd notice is that it's almost exclusively populated with either investors or entrepreneurs, so it's hard to argue against either side, to be honest. Ideally, you should understand and try to be good at both, but at the end of the day, I think it all depends on your personality. If you're more of a hands-on type of guy, go ahead and start a business, see how it goes, but be aware of all the risks. Maybe even watch some of my older videos on this topic. If you're more of a hands-off type of guy and you're just looking to invest, this video and many other future videos will show you the ropes. That being said, let's get back to the topic of capital markets. Even though you could practically buy any financial asset through a good online broker, and the markets are not really separated, theoretically, capital markets have two components: stock markets and bond markets. Almost everyone knows what a stock market is. It's a place where you buy stocks, right? Technically yes, but it's a bit more nuanced than that. Let's see what you can actually buy. Obviously, the first thing is individual stocks. You might have heard the terms stocks, shares, securities, and equities. Let me clarify them a bit. We'll start at the top layer, securities. This is the legal definition of a security. Pretty simple and straightforward, right? I'll use another method called the Howey test to simplify the definition for you. It goes something like this. If you invested money in it, and if there's an expectation of profit from that investment, and if the investment is in a common enterprise, where common enterprise means that multiple people pull their money together to invest in a project, and if the profit comes not from your efforts, but from the efforts of the entity and the people that you invested in, then it is a security. By this definition, a lot of the financial instruments are securities. If you hear someone say he bought equity securities, he refers to stocks. And if you hear someone say he bought debt securities, he usually refers to bonds. Now, if at some point you want to invest in cryptocurrencies, the definition of a security might make the difference between you making lots of money and you losing all of your money. A lot of cryptocurrencies can be classified as securities, but they didn't go through the legal process required to sell them. This means that the SEC, which stands for the Securities and Exchange Commission, could crack down on them at some point for selling unregistered securities. The takeaway from all of this is that a lot of the financial assets in the regulated market are securities, so you probably shouldn't bother remembering this definition. But at the same time, maybe you should remember it, especially if you intend to invest in unregulated markets like cryptocurrencies. Now let's look at equities. Equity indicates ownership in something. For example, if you own your house, it means you have 100% equity in it. A business can sell a portion of ownership in itself in the form of stocks. When you buy stocks, you're buying equity in that business. For practical purposes, equities are the same as stocks. So if equities are the same as stocks, what's the difference between stocks and shares then? Well, shares are the units that you divide the stock or the equity of a company into. Stock is a general term, while shares are specific to a company. For example, if you say to someone that you bought stocks, he will understand that you invested in the stock market and you bought shares in multiple companies. On the other hand, if you said you bought shares, the logical question that would follow is, shares into what company? You can buy 10 stocks, meaning that you invested in 10 different companies, but if you buy 10 shares, it means that you bought 10 units of ownership in a single company. It's important to mention that you can buy two types of stocks, and it's good to know the difference between them. These two types are common stock and preferred stock. The main differences between them are the following. Common stocks give you voting rights in the company, while preferred stocks don't give you any voting rights. On the other hand, preferred stockholders have priority over a company's income, meaning that they are paid dividends before common stockholders. They also have priority when it comes to the company's assets, in case the company gets liquidated. Common stockholders are the last in line to receive money from the assets that are liquidated. The creditors, bondholders, and the preferred stockholders will be paid first. Now, if at this point you thought to yourself that preferred stocks are superior, keep in mind that preferred stocks don't go up in price when the company grows. Common stocks do go up in price. Preferred stocks are very similar to bonds, in that they have a face value and they pay a dividend based on a percentage of that face value. They can be traded on the open market and their price will fluctuate, but their price will not reflect the company's growth. For that, you'll have to buy common stock. Well, I could make an entire video about this topic. For now, it's good enough that you know the difference between these two, so you don't accidentally buy the wrong type of shares when investing in a company. Now let's see what else, besides individual stocks, you can buy in the stock market. You can also buy index funds. To understand what an index fund is, first you have to know what a market index is. A market index is a hypothetical portfolio which represents a segment of the financial market. Even you can create a market index if you want to. For example, if you are interested in the top 100 tech companies in the US, you could filter through all the companies, eliminate those that are not tech related, and then do some relatively simple math and you got your index. The value of the index will come from the prices of the stocks that comprise it. So basically, you can think of an index fund as a portfolio constructed to match or track the components of a market index. The portfolio will contain shares or fractional shares in all the companies that comprise the index. The biggest advantage of an index fund is that it will provide you with broad market exposure, low operating expenses, and a low portfolio turnover. It's one of the closest things to passive income that exists. Some examples are the S&P 500. This is a stock market index that measures the stock performance of the top 500 largest companies in the United States. It's one of the most commonly followed equity indexes, and many consider it to be one of the best representations of the US stock market. The average annual total return of the index, including dividends, from 1926 until today is 9.8%. When you hear people talk about beating the market, they usually refer to getting a better return than the S&P 500. In finance, this is also known as alpha. The Dow Jones is another example of a market index. It measures the stock performance of 30 large publicly owned companies based in the United States. Another well-known one is the Morgan Stanley Capital International World Index, better known as the MSCI World. It measures the stock performance of 1,655 stocks from companies around the globe. Obviously, there are thousands of market indexes, and it would take days to go through all of them. You'll have plenty of time to learn about them, but for now, it's good enough if you know the most popular ones. The third type of asset that you can buy in the stock market is a REIT, or a real estate investment trust. REITs exist to answer the question, how do I invest in real estate if I don't have enough money to buy a property? A good analogy for a REIT is to imagine that you and your friends want to invest in real estate. Individually, you don't have enough money to buy a single property each, but if you pool your money together, you could probably buy one. You then rent that property and you divide the profits proportionally to the amount that each of you invested. If the property cost $1 million and you invested $200,000 each, you're entitled to 20% of the profits. A publicly traded REIT does exactly that, but at a much larger scale. It's basically a company that owns, operates, or finances income-producing properties, and it allows investors to buy shares in it and be entitled to the profits generated by the company. Legally speaking, they will take a 10% management fee and then share 90% of the profits as dividends for the investors. The purpose of a REIT is to allow you to invest in real estate without having to buy an entire property. Finally, we have mutual funds. A mutual fund is a professionally managed investment fund that pools money from many investors to purchase financial assets. Unlike index funds, mutual funds are actively managed and they have higher fees. You might have heard of them when your bank tried to convince you to invest with them and promised you'll not regret it. If you did invest with them, you probably regretted it. The sad reality about mutual funds is that 95% of them will not beat an index fund like the S&P 500. 5% of them will beat it, but you'll probably still end up with less money than an index fund because of the fees. Maybe 1% of the actively managed mutual funds will legitimately beat the market, but those funds are managed by the rock stars of the investment world, and the barrier of entry is so high that they are not accessible to you. You're better off just avoiding them. I'll have to stop here for now. I initially wanted to make a long video where I tackle the entire topic of capital markets, but it seems I'll have to split it in two parts.